All right, let's dive into one of the most baffling, counterintuitive puzzles in the entire tax code. We're talking about the scholarship paradox. It's that situation where a family does everything right. They save for college in a 529 plan, their student works hard and earns a fantastic scholarship, and then somehow they get hit with an unexpected tax bill. It feels completely backwards, but as we're about to see, it's a direct result of how different tax laws just don't play nicely together. So this is really the heart of the matter, isn't it? Can free money for college, a scholarship that's supposed to be tax-free, actually end up creating a tax liability for your family? Well, the short answer is a frustrating but definite yes. And today, we're going to deconstruct exactly how that happens, and more importantly, what you can do about it. And look, this isn't just some abstract, theoretical problem that only tax nerds talk about. This is a real-world headache for tons of people every single tax season. I mean, just look at this post from a taxpayer online. They're trying to figure out their Form 1098-T, where the scholarships in Box 5 are way bigger than the tuition payments in Box 1. This exact scenario is what sets off the alarm bells on the IRS computers and kicks off a total compliance nightmare. So to crack this case, we need a game plan. We'll start by really defining the paradox itself. Then we're going to dig into the statutory foundation, the actual tax laws that are causing all this trouble. We'll see how they create a coordination conflict, how that conflict pops up in what I call the 1098-T data trap. And then finally, we'll walk through the really powerful strategic allocation solution that can fix the whole mess. Okay, first up, the scholarship paradox itself. On the surface, you've got two amazing things happening: tax-free scholarship money coming in, and a tax-advantaged 529 savings plan ready to go. But, as we're about to find out, the totally separate rulebooks that govern each one can lead to a head-on collision that creates a tax bill you never saw coming. So here's the deal. The crucial point is this. The paradox kicks in the moment a student gets that tax-free scholarship. That great news can actually use up all the qualified tuition expenses, the very same expenses you were counting on to make your 529 plan withdrawal tax-free. And the result? The earnings portion of that 529 distribution, which you were absolutely certain would be tax-free, well, it suddenly flips and becomes taxable income. Ouch! To really understand why this happens, we have to go right to the source, the Internal Revenue Code. Think of it like we're deconstructing the DNA of the three key statutes that govern all the education tax benefits, because it's right here in the fine print of the law itself that this whole conflict is born. First, we've got Internal Revenue Code, Section 529. This is the one you probably know. It's the law that created the 529 plan, or a qualified tuition program. It's that awesome account so many families use, specifically designed so your savings grow tax-free and your withdrawals for qualified expenses are also tax-free. It's just a fantastic savings tool. Second on our list is IRC Section 117, which deals with qualified scholarships. This is the rule that says most academic scholarships are tax-free. But, and you have to catch this detail, it's only tax-free if the money is used for very specific things, namely tuition and mandatory fees. Any part of that scholarship that goes to, say, room and board, is technically taxable income. And our third player in this game is IRC Section 25A. This authorizes those super valuable education tax credits like the American Opportunity Tax Credit. Now remember, a credit isn't a deduction. A credit is a dollar-for-dollar reduction of your final tax bill, which makes it, by far, the most powerful tax benefit of the three. And right here, this is where the whole problem starts. Just notice the fundamental mismatch on this slide. Over on the left, a 529 plan has this really broad definition of qualified expenses. It covers tuition, fees, books, and even room and board. But look at the right side. For tax-free scholarships and tax credits, the definition is way, way narrower. It's usually just tuition and required fees. This difference is the little seed that grows into our big paradox. Now, all of this is governed by a core principle of tax law: no double dipping. You absolutely cannot use the same single dollar of an education expense to justify getting multiple tax breaks. You can't use $1 of tuition to make a scholarship tax-free and generate a tax credit and make a 529 withdrawal tax-free. The law forces you to pick one. This rule is what creates the big fight. Okay, so let's see how these rules smash together to create the coordination conflict. This is where we see what's called the Waterfall Effect in action. It's a mandatory step-by-step process for allocating your expenses that can literally shrink the pool of money available for your 529 plan all the way down to zero. Think of it like this, okay? You start with your total bucket of tuition expenses. First, the law says you have to subtract any expenses you use to claim a tax credit, like the AOTC. That gets taken out first because it's the most valuable benefit. Then, from whatever's left, you have to subtract the expenses covered by your tax-free scholarships. Only the tiny amount remaining at the very bottom of this waterfall can be used to justify a tax-free withdrawal from your 529. This final number has a name, your Adjusted Qualified Higher Education Expenses, or AQHE. This table lays out the formula perfectly. You start at the top with your total expenses, your QHE, but then you have to reduce that number, first for tax credits, then again for scholarships. The result is your Adjusted Qualified Higher Education Expenses, the AQHE. And here's the punchline. If a big scholarship wipes out your expenses and your AQHE drops all the way to zero, well, there are no qualified expenses left for your 529 withdrawal to cover. And just like that, the earnings portion of your withdrawal becomes taxable income. So you might be wondering, how does the IRS even find out about any of this? Well, it all comes down to one simple form and the automated computers that are programmed to read it. Welcome to what I call the 1098T data trap. The trap is brutally simple, really. The IRS computer scans your Form 1098T. It compares Box 5, scholarships, to Box 1, payments for tuition. And if Box 5 is bigger than Box 1, the system automatically assumes that extra money is taxable income. It's just a simple math check. The computer doesn't know about your other expenses like room and board. It just sees an imbalance and boom, it spits out a CP 2000 notice proposing you owe more tax. And what makes this trap even worse is the timing. The academic year and the tax year don't line up, and it creates a huge mess. Check out this timeline. In December 2024, a family uses their 529 to prepay the spring 2025 tuition, so their 2024 1098T shows a big payment in Box 1. But then in January of 2025, the spring scholarship gets posted to the account. Now, the 2025 1098T shows a huge number in Box 5, but almost nothing in Box 1. To the IRS's computers, both years look completely wrong, creating this massive 2-year compliance headache. All right, we have defined the problem, we've gone through the law, and we've seen the trap. Now for the good part, the solution. And it's going to require us to think about this problem in a completely different, almost backwards way. The most powerful strategy out there is called the inclusion election. And this is fascinating. It actually involves voluntarily choosing to treat some of your otherwise tax-free scholarship money as taxable income. I know, it sounds totally crazy to pay tax you don't have to. But as you'll see, paying a little bit of tax at the student's, hopefully low tax rate can unlock a much, much bigger tax-free benefit from the 529 plan. Here's the logic. You basically elect to have the scholarship cover non-tuition expenses first, like room and board. Now, since scholarship money used for room and board is taxable anyway, you're really just formalizing that treatment on your return. But here's the clever part. This strategic move frees up the actual tuition expenses. Those tuition dollars are now available again in that waterfall calculation, and they can be used as the basis for a totally tax-free 529 distribution. You're preserving the value of decades of tax-free growth. It's a brilliant move. Now, even with this strategy, your 529 withdrawal might still look non-qualified at first glance, and that usually comes with a nasty 10% penalty. But there's a critical escape hatch. On Form 5329, which is the form for additional taxes on qualified plans, you can claim an exception to that penalty for any withdrawal that is non-qualified because of a tax-free scholarship. The tax code itself recognizes this as a problem and gives you a way out of the penalty. But hang on, here's an advanced tip for you. Just because you solve the federal problem doesn't mean the state problem goes away. A lot of states offer a nice tax deduction for contributing to their 529 plan. But if you later take a distribution that's considered non-qualified, even if you got that federal penalty waived, the state might recapture that old tax deduction, forcing you to pay it back, maybe even with interest. You absolutely have to check your specific state's rules on this. So if you remember just one thing from all of this, let it be this. The Form 1098T you get from the school is not the final word. It is just the starting point. Real tax compliance and getting the best possible outcome here requires you to pretty much ignore the raw data on that form and manually reconstruct that AQHE waterfall calculation based on your actual total expenses for the year. In the end, the scholarship paradox is really a test. It's a test of your record keeping, sure, but it's also a test of your understanding of how all these rules have to interact. It actually puts you back in control. It's up to you to look at that scholarship and, through these smart strategies, decide its ultimate fate. Is it just going to be tax-free aid? Or is it the key that unlocks all that tax-free growth in your 529? The choice and the tax savings are yours to make.